Hi, everyone. This is Jason Burak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I've had him on, I think, last year. He is the founder of Freedom Fest, a popular libertarian and free-thinking conference where people who like Austrian School Economics and independent thought go. He's a PhD and editor of Forecasts and Strategies, a nationally known investment expert, economist, university professor, and author of more than 25 books. Thank you for joining us again, Mark Skousen.
Jason, it's a pleasure.
Now, Mark, we just have so much going on in the world. We've had the price of oil fall a lot unexpectedly since June. Looking at supply-demand fundamentals, I don't think demand has dropped that much, and the oversupply is not that much. We've had, the Swiss take off their currency peg. Obviously, I thought it was going to come off eventually because I don't think anyone can keep these currency pegs on and just eat enormous amounts of inflation. But are we starting to see signs that the endgame of Keynesian economics is approaching, with all these central bankers in so many different countries pretty much using the same type of Keynesian central playbook?
It doesn't seem to have the impact, the easy money impact that it's had in the past, although I do think that it's actually a continuation of what we've seen over the last 6 years, and that is the easy money has largely gone into financial assets for the recovery of real estate, for the stock market, for banks to basically rebuild their liquidity, and it has to some extent gone into corporate profits and the recovering economy. But it seems like most of the money, one of the things that Ludwig von Mises always emphasized was who gets the money first. And I think we're seeing that continue to go on. It is interesting that commodities is not one area that the money has gone into, and you can see that with lower commodity prices in the earlier stages of production. You normally see, if you follow the Austrian theory of the business cycle, easy money normally starts in the earliest stages and goes out from there on. But it doesn't necessarily have to be the case. The money can go elsewhere. Hayek talked about that in prices and production. And in this case, I think that's what's happening. The money is largely going into the easier sectors where the money can be placed. Because of regulation, that's one of the reasons why money is not going into the small business person. It's not going into basic production of commodities, goods and services, but it's in the financial instruments because it's easier to put the money to use there. I mean, that could change with Dodd-Frank. Bank stocks have not done very well recently, but you really have to follow where is the money headed. I think that's the key point of the Austrian insight.
Yeah, and what you talked about with Mises and Hayek, I think that insight originally came from what Richard Cantillon, who would have been an Austrian school economist if there was such a thing as an Austrian school economist, but it wasn't invented yet. So I mean, he saw, that the money trough, it was going to the people in power first, the politically connected, the highest financially connected first, and I think that's what's happened too, like you said. And when I have conversations with, regular mainstream business people maybe who went to an Ivy League school but haven't read any von Mises or Rothbard or Hayek, don't know anything about the Austrian School of Economics, they refuse to acknowledge that there's any, asset price inflation. They refuse to acknowledge that there's potential bubbles in the bond market, there's potential bubbles in the real estate market again, and that the stock market, the general stock market at least, people are paying a really high multiple here for companies that are not really growing their revenues. They're financially engineering their earnings higher with artificially cheap debt, share buybacks, et cetera, et cetera.
Yeah, I think that you're right about that, particularly the bond market. That's an interesting situation there because, of course, what drives the bond market is, without question, in my mind, is the CPI. And, of course, the CPI, this Consumer Price Index, has been tepid, to say the least. I mean, it's 1% to 2%. And now with lower oil prices, lower gasoline prices, last month we had a slight deflation, and now there's this great fear of deflation, which I have to agree with Murray Rothbard. I've never really bought into this bugaboo that deflation is this great evil. It sounds like the lower cost of living is a good thing. It's not equated with the Great Depression. In fact, I point out to people that there have been periods of time, such as the 1890s to 1912, 1914, where you had considerable deflation and very high economic growth rate. The 1920s was also a time when you had that, and to some extent the 1950s. So I do think there's a lot going on here that is the new normal, shall we say.
Yeah, I mean, if I'm getting beneficial deflation that the free market provides, from new technologies, innovation, lowering costs, higher productivity, if I'm getting a higher quality flat screen TV, I remember 12 years ago when I went to Costco and electronic stores when Circuit City was still in business, there was a 20 or 30 inch plasma TV and it was like $4,000 or $5,000. And, now you can get a really nice flat screen TV for $1,000. That's so much better. So that's the type of, innovation the free market provides. But the Keynesians make it like, all deflation is bad and evil. And I just think it's ridiculous.
Well, I do think that their concern is not so much the technology that I think they would grant that that's been beneficial. What they're fearful of is the debt holders, of course, that for the first time they're really going to have to pay back in more valued dollars over time. And of course, they're not going to be able to do that. And they're going to have to default, and this will lead to another depression and so forth. But look, we have seen over and over again how bondholders are able to, or companies are able to refinance if they have to, and where bonds are called and so forth. There are methods that can be done that won't be that destructive. But frankly, I think it's about time that the actual bondholders benefited, especially from government securities where they're actually making a little money.
Now, we've seen just enormous attempts at financial repression in Japan. The U.S. is attempting financial repression too. Many experts, especially in the mainstream last year, thought interest rates would rise drastically. And interest rates just keep going lower and lower in the U.S. I think that's intentionally with the Fed and the other mechanisms that are involved with the bank. Do you expect these larger developed world central banks like the Federal Reserve in the U.S., the Bank of Japan, now the ECB surprisingly doing QE and vitaling their mandates? Are we in a world where these central banks are, they're going to be on the phone doing conference calls with each other, and then they're going to take turns, doing quantitative easing programs? Oh, our currency is too high. It's hurting our exports. It's your turn to do quantitative easing. Okay, we've done it now for 6 months or a year. Okay, it's your turn again. Is that the type of new normal we're going to see going forward?
I don't think in those kind of conspiratorial terms. I just think that they look at the factors involved, and it just so happens that the U.S. started it, then it's moved to Japan, and they're engaged now they're doing it in Europe. I don't think they're necessarily taking turns from a conspiratorial point of view. It's just that they have seen it, quote, work, unquote, in the United States, and Japan has moved in that direction to kind of jumpstart things and stuff. I am intrigued by the zero and even negative interest rate development that is going on, and there's been quite a discussion on that among Austrians in Yahoo Finance that I've been listening to, and I particularly am interested in the idea that more and more institutions, they're almost required to hold a certain percentage of their portfolio in fixed income. And I know even the permanent portfolio fund keeps 25% of its portfolio in treasuries. There's a lot of that going on, and there may be an attitude of come hell or high water, we have to keep invested in these bonds, and we need to do this. Japan, I think that Japan is an interesting case where they're trying to use artificial means to stimulate their economy when there are legitimate ways that through lower taxes and through more transparency and deregulation with their financial institutions and just opening their borders. If they became a more heterogeneous society in terms of immigration, in terms of trade relations, that would be a better solution than the Friedman solution. And I do say this is the Friedman solution in Japan because I well remember in 1999, Milton Friedman writing an article in the Wall Street Journal saying, RX for Japan, print more money. The entire article was about printing more money. And when you hear that, you kind of wonder why. Friedman's always been criticized for being only money matters, and he bristled at that characterization. But there was right there an article, and I well remember I guess it was the year 2000 or right around that time period, there was a Mount Pelerin Society meeting in Vancouver, and I confronted Milton on this, because his topic was, are we suffering from creeping inflation or galloping inflation? And I said, isn't this an example of creeping inflation? And he said, if Japan didn't do this, so it would be a financial disaster. He was really angry at me for bringing up this issue.
That's interesting. In your new book, A Viennese Waltz Down Wall Street, which I really love, by the way, you talked about your friendship also with Milton Friedman. Milton Friedman is kind of known in libertarian circles. He has a lot of famous quotes about, the wrong stuff their government does. Like I think his most famous quote is about, the Sahara. If the government was in charge of the Sahara Desert, it would run out of sand in 5 years. But why do you think he wasn't a free market, type of competing currency or gold standard type of person with his monetary policy when it came to gold, but he seemed to be a libertarian about other issues?
Yeah, he really was very libertarian. I mean, I don't really buy into the critics of Friedman saying he was a statist and stuff like that. I think he was basically genuinely interested in providing a stable monetary system, and how can you do it in today's modern world? And so he was he spent quite a bit of time looking at the gold standard. He talks about that in a number of his books, and he points out that the money supply under a pure gold standard, the monetary foundation would not increase fast enough to keep up with economic growth and would result in gradual deflation. There's that bugaboo in deflation. I don't think it's a problem, but he wanted something that had a stable price conditions, and based on that, he went to an alternative, which, is the monetarist rule, increasing the money supply equal to the long-term economic growth rate of a country, which in the United States is 3 to 4%. And he thought that would work. It is interesting, I think, that the money supply has been growing under all the Fed chairmen at a fairly steady rate of between 4 to 6%. Right now it's around 6%. And so they have kind of adopted the Friedman monetarist rule in that respect. But I do think that Friedman, this was his one weakness, primarily was in, he was basically a monetary Keynesian in the sense that easy money was his solution to Japan. And even though he died in 2006, I believe he would have been very much in favor of what the Fed actually did of pumping money into the system. I don't think he would have been a big fan of TARP, because he didn't think fiscal policy played much of a role in the business cycle. But monetary policy, he thought, could be very active during a crisis, just like the Great Depression, and he would favor that sort of thing. So there's no question that I think he was weak in this issue when the Austrians have a stronger position.
Yeah, I agree with that. Now, do you think if Friedman were still alive, do you think he'd be telling Japan to print even more money?
Oh boy, he probably would, because that's what he wrote in 1999 in the Wall Street Journal: print more money, get the economy going, rather than more fundamental. I confronted him on this. Why didn't you talk about more fundamental, genuine reforms rather than this artifice? And he said, well, his attitude is that it would break the down the system, so that if you got the economy recovering better, then you could shift to these other reforms. So his number one choice was print more money. So yeah, I think he would be a fan of Abenomics, not the tax increases. He would be in agreement with Paul Krugman. Even Krugman says that the tax increases as a Keynesian is a very bad idea in Japan. It's one of the reasons they're continuing to suffer.
Yeah, it's just really interesting. I'm not sure Japan, like, printing more money is going to help them at all. It seems, their import prices for food and energy, because they don't have their own resources. They produce a lot of, high-end electronics and other goods, but they don't have their own resources. So everything they have to import with their money printing is going up in value, which is, causing, like, basically stagflation to them, and I think they're going to get worse and worse stagflation going forward. Now, you've done a lot of interesting research work on the flaws in GDP. James Grant of Grant Interest Rate Observer has made some interesting comments about the problems with GDP, and so has the Austrian School. What's your opinion on the flaws with the calculations in GDP, CPI, employment? We're starting to see, these mainstream businessmen like the Gallup CEO. I think he just put out a piece on LinkedIn, and it's very it's stuff that you and me and other Austrian School people and libertarian people have been discussing, that a lot of these statistics, are compiled by Keynesians and people who, are using certain types of statistical models that are flawed. Do you think more people are waking up to the problems with these statistics?
Well, yes. I mean, the fact that the Wall Street Journal finally published my piece on gross output, which is this new statistic that the federal government, the Bureau of Economic Analysis, is coming out with every quarter now. It's the first. Gross output is this new statistic that honestly is a measure of Hayek's triangles, because it's a measure of spending at all stages of production. Now, they still leave out some stuff at the wholesale and retail trade equal to $7 trillion in the economy. So it's not a perfect measure, if you will, of Hayek's triangles. But the fact that they're doing this and coming out every quarter with this is really significant. I think it's the greatest triumph in Hayekian macroeconomics since Hayek won the Nobel Prize in 1974. But I'm still having some pushback. I mean, what really surprises me is that economists at the George Mason University and elsewhere, the traditional vanguard is having problems accepting this analysis that I've built my career on, having written the books The Structure of Production that came out in 1990, where I proposed that we need a measure of Hayek's triangles. Now, granted, it is a single statistic that Austrians don't particularly like, and Hayek himself never tried to estimate it. His book was purely theoretical in prices and production. But look, you're never going to achieve any success if you don't develop some statistics to support the Austrian concepts. And so mine can be integrated into the textbooks. I think it's driven my structure of production is they're coming out with a new third printing with a new introduction just this year. So there's a lot of interest. But the other thing that I wanted to mention that I think is really important is that out of this gross output statistic, I've developed a new statistic called the B2b Index. So what this is a measure of business-to-business transactions, which is a measure of the early stages of production and the intermediate stages of production. And I developed this idea because GDP basically leaves out almost all B2B, business-to-business transaction. And so it gives the false Keynesian impression that consumer spending and government spending, the two biggest sectors of GDP, are what drive the economy rather than the business sector and entrepreneurship and Say's law and everything that we hold dear, which when you use this B2B index, you find out it's $23 trillion. I just did this research on this. It's $23 trillion. That means B2B activity, business-to-business transactions, is almost double consumer spending in the economy, or what we call B2C, and it is substantially bigger than gross domestic product, GDP itself. What's great about this is it demonstrates what we all know in economic growth theory, that business investment, productivity, entrepreneurship, capital investment is what drives an economy. And this, my B2B index is a way of doing that. So lots of really positive things have come out of this new gross output statistic, and I really hope all of your listeners will just Google gross output, Forbes magazine or Wall Street Journal, or my name, Mark Skousen, and all kinds of information will come out, and we can start using this data because it's right there. The government's coming out with it in the United States. The UK now has a total output statistic. I know Japan is interested and Korea is interested. They've all approached me about information on how to create these new statistics. So it's all a tremendous positive that really has made me much more positive and on the outlook for Austrian economics. And by the way, the textbooks are also including gross output. Roger Leroy Miller's Economics Today has a couple of pages on it, and David Colander of Middlebury has written about it in the Eastern Economic Journal with my rejoinder. So there's lots going on there. It's just the only sad part of it is that the Johnny-come-latelys on here are the economists at GMU. I can't understand it.
Well, I mean, it's just the way with academics, Mark. You know, you teach in academia, and, some academics, whether, they're libertarian or Austrian school or not, it's just very tough, and some ideas are entrenched. It's very difficult to get new ideas established. You know how it is.
Yeah, I know. Success is funeral by funeral, as Max Planck used to say.
Yeah, and we're built with Wall Street for Main Street. Once we raise capital, we're going to build virtual classrooms, so maybe you could teach about gross output. But that definitely sounds like a more accurate way than a lot of the government statistics are doing now for GDP and CPI and the unemployment rates, because we're starting to get more mainstream people, whether it's Donald Trump or the Gallup CEO, come out and say a lot of these statistics that they're looking at, they're not reflecting reality. So we want something that reflects reality. I think there's been a lot of pretty good entrepreneurship the last 12 years. In the United States especially, there's been a good amount of new products and services, especially in technology. And, there's been a lot of monetary, a lot of inflation, from a strict Austrian school point of view put into the base money supply. But I think, these entrepreneurship, new products and services, lowering prices, solving problems in the real world, they've lowered other people's costs and prices in a lot of business and industries. And to at least a certain extent, it's at least offset some of the inflation that's gone into the real economy.
Yeah, I would agree. And by the way, I'm at Chapman University right now out in California, and I'm teaching libertarian CEOs, and we're studying Coke, Charles Koch and Koch Industries. And it's really fun to just delve into the Austrian school, which forms the basis of Koch's market-based management and what's all the development that's going on in that area as well.
Yeah, and we've talked a little bit about the Austrian school here and there during this interview, but what do you like best about the Austrian School Economics that you think makes it better than the other schools?
Well, we talked about that in my class yesterday. When you go to Carl Menger and the foundation, the fact that he talks about a structure of the economy, that's what's so powerful, because normally you look at just final output in the standard model, which is the Keynesian model, and in the Austrian model, you look at production at all stages of production. So instead of looking at just one interest rate, the 10-year Treasury, you look at the yield curve. When you look at prices, you don't just look at the CPI, you also look at the PPI, the Producer Price Index, the Commodity Price Index. You look at relative prices, not just total prices. And I think it extends with unemployment and employment statistics. Did you know that 80% of employment in the United States is in the earlier stages of production? Only 20% of employment, people working, is in retail and leisure, the final stages of production. So all of that indicates that you don't want to just look at the statistic, but you want to look at an array of statistics. So Austrian economics appeals to me because it's a form of complexity economics, which is the popular thing that people are looking at right now, that you can't just simplify economics with one statistic. If you really want to understand what's going on, you've got to look at the structure of the economy, and that's what the Austrians do.
Yeah, I think it's just an amazing, it makes so much sense from a common sense perspective. And if something, is way too theoretical, and then you see in the real world that it just doesn't work, and a lot of these Keynesian stimulus policies, and I go back to Japan, and there's so many other examples, even, with a lot of the FDR, the policies FDR tried in the New Deal and other stuff, a lot of them didn't work. But, the Keynesians just keep doubling down and things like that. And when I was a stockbroker in 2007 and 2008, right as the market was crashing, and, I was looking for answers, and all the stuff I was reading on the mainstream website, CNBC and Bloomberg, none of from the regular, Keynesian types, it didn't make any sense to me, Mark. So, as I started finding Peter Schiff and other people's and other Austrian School experts' work like yourself, it just started making more and more sense to me. Like, hey, this sounds like an interesting explanation. Someone had to see these problems in the economy, the housing bubble, the banking, the over leverage with the banks. Some people had to see these coming from a mile away, and it just seems that a lot of the people, that were in the mainstream, the Keynesians, none of them saw any of these things. But you go back and look on Mises.org or other people, experts like yours, and, they saw things based on the Austrian school that, they didn't know the exact timing that, this will occur a year from now or something like that. But they saw, that the wrong things were in place. There was humongous malinvestment, and that we were having these bubbles develop because there was so much misallocation of capital.
Yeah, and this brings up what we're doing at Freedom Fest this year, and I hope that your listeners will consider coming to Freedom Fest July 8th to the 10th in Las Vegas. And we're confronting the number one Keynesian on this issue. Paul Krugman is coming to Freedom Fest and debating Steve Moore, and I'm going to be the moderator. And we're going to go down issue by issue, austerity versus stimulus, progressive versus flat tax, red state versus blue state, a review of the history and what went wrong and so forth. This will be very enlightening, and we're doing it in a very professional way, so it's not going to be like Fox News or MSNBC where it turns into a shouting match. At least let's hope it's not going to do that. And I'm very hopeful. I mean, this is a major breakthrough in our movement to have the two top Keynesian economist and supply side economist with me as the moderator. I think it's going to be a really revealing opportunity here for us to get to some real answers.
Yeah, it's really exciting to actually get Krugman there. I know Robert Murphy of the Mises Institute has been trying to challenge Murphy for, I think, the last couple of years in a debate, and I think there's over $100,000 that would go to charity, and Krugman has refused. So it's good that you finally got him.
Yeah, he's actually turned down many debates over 8 years. It took me 8 years to get him, and finally he agreed to Steve Moore. to do it. He felt he was a worthy opponent and stuff. Now, Robert Murphy is going to be at Freedom Fest. He's doing our mock trial against we're putting the Fed on trial, and he's going to be the prosecutor. So it's going to be a fun thing going on there. So I think we're going to allow a time period with Q&A, and I'm hoping Robert Murphy will be able to ask directly a couple of questions to Paul Krugman. So there may be a mini debate going on there. So we're definitely going to have a lot of Austrians there that are going to be peppering the floor with questions during that debate.
Yeah, I enjoyed seeing on Bloomberg, I don't know if you watched it, Ron Paul got about 10 minutes or so with Krugman, and he basically, and he got Krugman to kind of admit that they were doing kind of Roman Empire tactics with some of the monetary policy. It was really funny the way Ron Paul got him into that.
Yeah, no, it was, and those kinds of media events occur in an unexpected way, but when you actually formally ask Paul Krugman to do a debate, he's turned everybody down until now. So we're pretty excited about this. So if you're people, just go to freedomfest.com. You can read all about it and hopefully sign up and attend. We think we'll have a standing room only crowd. We already have 1,000 people signed up, so it's pretty exciting.
Very nice, and you have a lot of big-name guests, and you also have an entrepreneurship contest, right, for libertarian entrepreneurs.
Right, we're offering an award, a $50,000 award, winner take all, for the best startup entrepreneur idea of 2015, and those there's a whole. They just go to the website freedomfest.com. We tell them how you can apply and stuff. It's going to be pretty cool. We're going to have 100 entrepreneurs in one room who will qualify, semi-qualified, and then out of that, 4 will be selected to appear in front of everyone in the general session. And we have John Mackey, we have Steve Forbes, we've got Rick Rule. We're talking to Peter Thiel about it. I don't think he wants to be a judge particularly, but we're putting some pretty high-powered people with John Mackey of Whole Foods Markets and Steve Forbes and stuff as the judges, and they will choose out of that one big winner. So it should be fun.
Yeah. Did you also say that? I think I heard that you're getting Steve Wynn, who's normally a Democrat. Is he coming to the conference this year too?
Right. He's tentatively accepted the invitation to come. John Aglioloro is working with us on that. He's the producer. The wealthy businessman who produced the Atlas Shrugged series of films, and he's working. We haven't fully confirmed that yet, but he does seem to. Steve Wynn has initially indicated a willingness to come and speak, and he's been very critical of Obama, as you probably know, and that's the kind of interesting people that we like. Is that whether they're Republicans or Democrats or what have you, if they're saying the right things, that's all that matters.
Yeah, I agree, and I've listened to his conference call. Zero Hedge has posted them in his writings and stuff, and he definitely appears to be waking up. I think in general, the Republicans and Democrats, a lot of them are basically Keynesians. They just disagree where to spend the loot, either on welfare or warfare or whatever pet project they have in their local district. But, there's not a humongous amount of differences between both parties, and it's good to see people from both parties starting to wake up and kind of realize something that we've realized for a while, that, they're both using bad economic policies, in my opinion, instead of the right type of economics.
Yeah, exactly.
Now, my final question, Mark, has to do with value in the stock market. You run a newsletter too for investment. You've been involved in a lot of investing. You've talked in your new book, Viennese Waltz Down Wall Street, how just because the commodity producer is below the price of production doesn't mean you should necessarily buy the commodity price stock. Where do you see value in the stock market then? Do you see good value then in commodity producers, or do you see it somewhere else?
As a matter of fact, I do think I'm finally warming up to commodity investing, at least in my trading services. I haven't actually put them back in forecasts and strategies. We sold out of our gold position in late 2011. It was a pretty good call. and we have not been back into gold since then, but I'm warming up to the idea. And in oil cases, we sold out all of our oil and gas service companies, and boy, that was a good time we did, because those stocks have really fallen off the cliff. But I'm warming up to all of these commodity markets right now. It appears the Federal Reserve and other central banks have adopted a permanent low interest rate policy, which comes out of Keynes's general theory. He actually advocated permanent low interest rates, and they're deliberately trying to do that. And of course, they can do that as long as the CPI doesn't take off. But when the CPI takes off, they're going to have no choice but to raise interest rates. That's the hurdle. Rising real interest rates are the hurdle that commodities need to face, and it looks like they're moving toward more. The central banks are moving toward more inflation again, and that's why I think commodities are starting to look much more approachable in terms of a buy opportunity. A lot of these oil companies are now losing money and having to cut their dividends, so that's a good sign that we're nearing the bottom, I think.
Yeah, I think there's a lot of bargains to be had in the oil patch as long as the companies, their production costs are not too high, they don't have too much debt.
They've really been cutting costs. I mean, they're cutting costs right and left. And the only one company that we've continued to maintain is with the pipeline company, Enterprise Products. They seem to, they have a rising dividend policy every quarter. They seem to be able to continue to do that. So we think there's some bargain opportunities there.
Yeah, I think there's a lot of bargains in the MLP space as well. Like you mentioned, cutting costs. The gold and silver miners, really, the last 2 or 3 years, the primary gold and silver miners, they've had to enormously cut their costs. So I think they've already been through what the oil guys the oil producers are going through now. Mm-hmm. So I think the gold and silver miners are definitely, I think we've definitely hit a bottom here. Maybe we go sideways for a little bit, but it appears the cyclical bear market in gold and silver mining stocks is over. Went from 2011 to 2014. Yeah,
I tend to agree with you. And Don Smith, who's one of our main hedge fund money managers out of New York, who speaks at Freedom Fest every year, he's done a remarkable job as a deep value investor. And he's been buying a little bit early, but he started buying the gold stocks late last year, started losing money, but now is looking pretty prescient. So I can understand that perspective, and it makes sense to me.
Yeah. I mean, and considering, the valuations the market is paying for some regular general stocks, with companies that, are financially engineering their earnings, are not really growing revenues. And it just seems like, as a contrarian, as a value investor, I'm looking for undervalued growth. I don't want to pay, 25 times earnings for a stock that's not really growing the revenue. So, and not really good dividend yield. So there's just the general stock market isn't really appealing to me at this point in time. I think it's overdue for a correction, but I'm not really sure if, the Keynesians are going to allow it, because they seem completely intent, as we discussed earlier, on asset price inflation.
Well, no, we're actually in many ways we're in that sweet spot of investing where you have low inflation, you have an easy money policy, you have a lot of corporate cash on hand that could be put to use. It'll be interesting to see what the employment figures are over the next few years, whether they can whether the accountants and the tax attorneys can adjust to this new environment of higher regulation and get their, the IPO market is a good example of that, where after Sarbanes-Oxley, the IPO market was dead in the water for 10 years in the United States, and now it's one of the most. Lots of companies are going that route, and it looks a little bit like a bubble again. It's pretty amazing.
Yeah, I think a lot of these IPO companies, there's just been so much money coming in on crowdfunding. There's also, a lot of CEOs in technology companies who don't want to go public. But, once you take investor money, venture capitalists, angel investors, they want to cash out. So that's probably why there's so much pressure to go public and stuff like that, because all those guys want to cash out. I just want to thank you again for your time, Mark. Please tell listeners where they can find your newsletters and your books.
Yeah, so Viennese Waltz Down Wall Street is available at Laissez-Faire Books, or just buy it on Amazon. My Maxims of Wall Street is in its third edition. That's available also on Amazon. My newsletter is at markskousen.com, and my conference, freedomfest.com, is the source for that. So I look forward to hearing from anybody, and I've enjoyed our visit.
Great. And hopefully we can have you on again soon to talk about this. I really enjoy your point of view, learning about, you wrote a book about Keynes and Marx, and it's just a lot of the mainstream won't discuss this. I'm not even sure how much of the mainstream media, has even read Keynes's general theory book. So, having someone who's read all these different schools, there's not that many people that have even read the books from all the schools. So it's very impressive, and I enjoy speaking with you.
Well, thank you. I wrote The Making of Modern Economics, which involved a lot of research and work, and that's also going into its third printing as the #1 history of thought textbook in the country. Not that people study history very much anymore, but it is something I'm very fond of, the work that I've done in that area.
Yeah, I really enjoy history. It was one of my undergraduate majors in college, and you're exactly right. Most people nowadays, their idea of history, is what happened last week or last month.
It really is. Although a lot of the schools now, after the financial crisis, are starting to offer courses in the history of financial crises. I know they are at Columbia and other schools.
Well, hopefully then they should look at Rothbard's books and, Niall Ferguson's books and Thomas Woods' books and your books instead of, just picking out only Keynesian books for their viewpoint of financial history then, because as you know, I think it's going to be one-sided, like with what Irving Fisher said about the Great Depression in 1929 and things like that.
Yep, good point.
Okay, well, thank you again for your time, Mark. I really appreciate it. Happy New Year, and hopefully I'll see you at Freedom Fest.
Okay, great. Thanks a lot, Jason. Bye-bye.